objective of your financial reporting is really exactly as it's stated here. Predict where you're going based on where you've been and drive to where you want to be. Some of the slides that Jody showed last week, we're going to talk about in a little bit more detail today and go into how we can generate this information, how we can use this information. So we talked a little bit about where we've been. We talked about realization, how close are we getting to our target bill rates, how are we doing in terms of our average invoicing hours rate versus our bill rate, how is our revenue trending, these types of metrics. And one in particular we're going to take a look at right now is this idea of a revenue plan versus actuals. So let me show you my OpenAir instance. What you're going to see here is a few dashboard reports that we've put together. Starting in this Financials tab, you'll see that we have a forecast versus budget with no expenses involved report. Now what this report is designed to do is show me exactly what that title would suggest. What is our forecast versus our plan? Where have we been as far as our billings, and where are we going in terms of our projections? Now you can see both in this chart because you have the ability to combine past data with future data. And this is done through a custom calculation that I'll show you here in a second. Now this is all sandbox data, so I apologize if the data looks a little wonky. It is mostly realistic, but some of it is cooked, admittedly. What we've done here is we've shown our client financials versus our prospect financials here in blue, but we also have this orange line of internal. What that is for is to show us some kind of a target, where we expect it to be, where we want to be. And the reason that's under internal is that what we've done is we've assigned bookings and financial metrics to an internal project that we know will never get billed and will never get counted in terms of our actual revenue. That way we can basically trick OpenAir into thinking that that's revenue, so it'll show up display on the graph, but it will never actually be billed or anything in that regard. So we know that it'll only show up as a metric, as a baseline for us. I'm going to go ahead and click this chart that lets me go to the actual report that is producing this data. What you'll see here is the tabular version of that graph. A bunch of clients listed here, projects and clients, as well as the numbers for 2017 that we're calling invoices total billing. Well, what is that? Invoices total billing is a combination of past data with future data. Our invoices and our bookings. Let me show you the custom calculation that goes into building that particular metric. I'm going to go into the administration page, and in the custom calculations, I'm going to find that total billing metric. I have to bear with it for just a minute. It's a sandbox. So it's a little slow. Here we go. Now if I find the total billings metric, the way this is composed, as you'll see, is that it's adding our projected dollars to our actual billed dollars. So we have our invoices total, which is what we've actually billed, and we're adding our projected billing from our billing rules. And so what that would provide me is a view of what this looks like in the past and in the future. So if I'm looking at this report in April of 2017, for example, I will know that this data is real this actually happened, and this data is our forecast. So you can kind of combine the two into one report. And then on your dashboard, you can have the ability to see where you are going to be, where you have been against your plan, the orange line, and where you're going to be against your plan over the course of the rest of the year based on your projected billings. So that can be really useful depending on how far out you're able to book your resources and how far out you're able to project data. So that's one of the reports that Jody was showing last week that we kind of wanted to go into a little bit of detail. This next one is also really useful in terms of measuring the health of your organization. We have a capacity versus revenue. And we can show you that on the actual dashboard. Here, now this is for 2016 data in our sandbox, because our sandbox has not been refreshed in a little while. But what you're seeing is a month-by-month comparison of what our capacity was and what we actually brought in. Now you can define capacity in a number of different ways. You can determine it by if everyone was fully booked. You can determine if everybody was a certain percentage booked. That would be your capacity. And so you can determine how many people and what your capacity is based on that kind of a calculation. Then you can measure that against that total billing stat again. How did we do against that capacity? In this particular case, it looks like we're hitting a good 80%, 90% of our capacity across the month. And obviously, this is a cumulative total. So you can see it goes inception to date, year to date metrics. So this is a really good measure of, are we staffed properly? Do we need to hire people? Is our capacity accurate? Are our target utilizations accurate? How are we doing in those regards? And to build this report, again, we'll click on the report icon to show you the actual report. We have our total revenue capacity number and our total billing number. Well, we already looked into what that total billing number is, and it's basically just exactly that, our billings. The revenue capacity, however, let me show you that custom calculation. Should I get the exact name? So what the total revenue capacity is doing is it's combining this revenue capacity employee versus revenue capacity hire. It's adding those two values together. And those are these two custom calculations that you see here. And what we've done is we've built each one with a filter. So if we look at revenue capacity employee, you can see we're looking at the base target hours times the target bill rate for that person. Okay. So that should show us exactly how much we would expect to bring in for anybody who is an employee. Their target hours for their base work schedule times their target bill rate. If we look at the same thing for new hires, we'll find that value again. You can see now we're taking the work schedule hours times the target billing rate instead of the base work schedule hours. And we've got this filtered so that we're only showing these two generic resources. So what we've done is we've created generic resources for potential new hires. And we've put in work schedules for them to show when we expect that they will start. So we had one with a work schedule starting in September, one in June, and we filtered on just those two people. And now the report will show what we expect for revenue from those two based on when we have them starting. That's the reason we use work schedule hours instead of base work schedule hours. If you're not familiar with the difference is that a base work schedule takes into account someone's work schedule regardless of any schedule exceptions we might have put in on their records, such as vacations, etc. Whereas the work schedule will take those into account. And so we can say this person's not actually even here until September, and it will take that into account and not count any of their hours until that point. And so that's how we came up with this report, with the revenue capacity against the total billing. So now we can see how we're doing against our plan. Now, if you look at our real data in our actual OpenAir instance, and if you know Jody at all, what you would see is a lot of people, when we break this down by people, we see a lot of people that are right about their capacity, give or take a little bit. And then we see Jody, who is twice her capacity. So that happens on occasion, and it's something that this will help you look out for as well. If you have people that are going above and beyond and maybe putting in quite a bit more time than you would expect, or even that you necessarily would like them to have to put in, this is the kind of report that can tell you that, because you break this down again by user. So continuing on, one of the things that Jody had indicated on our plan that we were going to talk about in this webinar is this whole idea of intercompany revenue. So I want to touch on this. Intercompany revenue is the idea that you are working on a project for another department in your same organization. And that always gets tricky in terms of sharing the quote-unquote credit for the work that you're doing, as well as the cost for that same work. How do you share that cost? How do you share that revenue? So one of the things that you can do in OpenAir, the way that we would recommend approaching this problem, is to use this concept of intercompany revenue, where the timesheet actual cost minus the timesheet current cost is your key metric. Now, what does that even mean? Well, the actual cost is an override that you put in OpenAir of the cost that is agreed upon between the two quote-unquote companies, or departments in this case. And so you are deciding, we will do this work for you. We're going to charge you, X dollars an hour to do this for you, other department. And then the current cost is that what that is actually costing that second department to do the work. So if they were doing it for themselves and not charging it back to another department, how much would it cost them to actually do? So for example, let's say we have a U.S. office and we have a resource in that U.S. office that costs us $85 an hour. The charge that we're going to charge the U.K. office for this person's time, they're trying to borrow this person for a project, is $100 an hour. So we're going to set our override on the project, or if you want to go down to a specific task level, to $100 an hour. So now what will happen is when we calculate the timesheet actual cost, it'll be 5 hours. We're assuming that this person puts in 5 hours on this project. We'll bill or attribute $500 in cost to the UK office. If we are looking at it from the other perspective in terms of how much it actually costs this US office to provide this resource, we'd have that actual cost, not the override, at $85 an hour multiplied by the cost that we have to that UK office, or to the US office, excuse me, the $85 an hour, gives us the $425 an hour. And so now we have an intercompany revenue amount for $75, or basically $15 an hour. That's the difference that they would quote-unquote earn for the charge out to the UK office. So this is often handled, as the slide indicates, on the ERP side, like within your financial app, but you can handle it within OpenAir as well by building these different custom calculations to handle intercompany revenue. Another item we wanted to take a look at so you'll see in one of the things we talked about on the slides here was determine budget to actual on a project view. So what I want to show you at this point is how you would view that on an actual project. So here's a project that I'm using as an example. Under this Financials tab, you'll have this Analysis option. Now you may or may not see this in your instance. It's role-based, so depending on your role and your permissions will determine if you can see this or not. If you click the Analysis link, you can see a number of different financial items about this particular project. This will show you your hourly charges, any flat rate charges you may have, others expense items, how many receipts you've turned in versus how much that has cost this project. And then if you're using the purchases module, you may have actual product charges as well that will show up here. And that'll give you a total of all of your income for this project. Now you can see what your costs are for this project. Well, we have users' time from their timesheets. It's costing us $22,000. So we've brought in $44,000, but it's cost us $22,000. Now you may look at this and say, why is there a discrepancy between this 98 in this hourly charges count and this 258 in this users' time from timesheets? The reason for that is that this is a count of the actual number of charges. So if somebody put in 3 hours on this project on a certain day, that's going to create one 3-hour charge. So here it counts as 1, here it counts as 3 because this is not the number of charges, this is the number of hours. Now the receipts will usually be identical because this is the number of charges that has been created from receipts, and this is the number of actual receipts. Well, in OpenAir, generally, it's a one-to-one situation where every receipt calculates a different charge. Now, why are these values different monetarily? Because in this particular case, this project has used a slight markup on its expenses, which is an option in OpenAir, if you're not aware, that you can use to say, for every expense that I incur on this project, I'm going to bill it back to the client with a 5% markup. And that is something you can do within the billing rules in OpenAir. As we go down further in this analysis, we see this profit summary. Now we can see our profit of incurred cost versus our income and our incurred cost versus our budget. So our income so far has been $48,878.88. Our cost has been $26,000, excuse me, $478.04. If you take that and calculate your profit based on those figures, you get a profit margin of 45.8% or a profit total of $22,400. So that's our profit versus our actual income. If you want to see the profit versus what we expect to bring in on a project, you can look at it in terms of our incurred cost versus our budget. And now we can see, now we have a budget, as you can see here, of $50,000. Whoops, excuse me. We slide that down properly. So we have a budget of $50,000, and again, our income of $48,878. So now we can see we're making incurred cost versus our budget. Our $26,478.04 divided by our $50,000 gives us a 47% margin, as well as an actual profit of $23,500. And so all of these measures are available within OpenAir to see how are we doing on a project health standpoint. Now, as an executive type or a department manager or project manager with a portfolio of projects, you may not want to view this in this form. You may want to view this across multiple projects in one view. One of the things you can do in that case, again going back to the dashboards, is that we can look at a dashboard report that looks similar to this. And what this is showing is For our top 10 clients, I like to whittle these down to the top X so that I'm not looking at real minutia data. And I'll show you how to do that in just a second. For the top X number of clients, here's where we stand in terms of our booked hours and our timesheets. And so this can tell us how much of our actual time that we have projected are we really using. This particular project is not a great example. This is a project where we booked 180 hours in that month, but we actually only put in 74. So if I'm seeing this on a recurring basis for this project month after month, I probably want to talk to the project manager on this, whoever's putting those bookings in, and say, you know, it looks like we're overbooking people. We're not getting the full amount of capacity that these people have. We're not putting it to good use. Same thing with this project, where we've got 71 hours booked and we only worked about half that. Here we have 70 hours booked and we haven't worked any in November, or that particular month. And then we move over to this project and we can see we booked 50 hours, but we put in more than twice that when we actually did the work on this project. This is another red light that I'm going to want to talk to a project manager. I'm going to want to talk to maybe the people who actually worked on this project and determine why we put in so much more time than we expected. Now, I know that some of our clients have a business process of overriding past bookings with actual time data. So, for example, after the month of February is done, someone goes back and updates all of the bookings for February with what people actually did. There are a few reasons that people do that. I'm going to advise against it, and I'm going to advise against it rather strongly. And the reason for that is that you then remove any ability to determine how you are doing against your forecasting. Because you've removed your booking numbers, you've removed your forecast essentially, and you can no longer see we have this pattern of overbooking people, or we have this pattern of underbooking people. That data goes away. Now, if you're curious as to why people would do the overriding of the bookings with actual data, it allows them to use things like the bookings worksheet to see not only what they have in the future, but what they did in the past, all in one view on that worksheet. I would posit that there are other ways to get that same information through reports such as these that would allow you to do that without having to override them. Okay, that is what we wanted to cover today. I hope this has been helpful. I did promise that I would show you how to limit these to just a certain number of your top 10 values. If you look at this edit button on this dashboard graph, you'll see that you have this option here. Display the max values will display everything it can, and then you can set certain limits to display only the top X number. So if I set this to display the max values, what you're going to see is, in my opinion, not real useful. At this point, I'm going to need a magnifying glass or a bigger monitor to see what's really going on here. And then I get down. Now some of these are pretty interesting because I do see way down at the bottom of this tail, at least I did, that I have projects that are being worked on with no bookings at all down here at the end of the spectrum. Dawn Media. So I'm going to be interested in taking a look at that. But by and large, this is where I want to focus my time.